Hello and welcome to the channel where we demystify the markets and empower you with financial knowledge. Today, we're diving deep into a fascinating corner of the market, hard to borrow stocks and the mechanics of a potential short squeeze. We'll be focusing specifically on one stock that has caught our attention with some incredibly high borrowing fees, the GrowHub Limited, ticker TGHL. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zoom in on TGHL, the GrowHub Limited. This company operates in the technology and software infrastructure sector, functioning as an investment holding company. Their core business involves providing product traceability, data analytics, and product trading facilitation solutions both in Singapore and internationally. Think about tracking goods from raw materials to final product, that's their game. Currently, TGHL is a market capitalization of $21.08 million, making it a smaller player in the tech space. But don't let the size fool you, because something unusual is happening under the surface with its borrow rates. What is cost to borrow and why it matters? So, what exactly is cost to borrow? When a short seller wants to bet against a stock, they first have to borrow shares from someone who owns them. They then immediately sell these borrowed shares, hoping the price will drop. If it does, they buy the shares back at a lower price, return them to the lender, and pocket the difference. But borrowing isn't free. There's a fee and interest rate paid to the lender, that's the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. Why does it matter? A high CTB usually indicates two things: either there's a very high demand from short sellers to borrow those shares, or the supply of shares available to borrow is extremely low, or both. When the CTB starts climbing significantly, it acts like a rising pressure gauge for short sellers. Why this stock is hard to borrow right now? This brings us directly to TGHL. The GrowHub Limited has appeared on our hard to borrow screener for a very compelling reason. Its annualized cost to borrow fee is currently sitting at an astounding 773.1%. Let that sink in. Short sellers betting against TGHL are paying an annual rate of over 700% just to hold their positions. This figure is exceptionally high and signals extreme demand or scarcity. TGHL has an estimated float of 12.7 million shares, which is the total number of shares available for public trading. When a significant portion of this float is already tied up in short positions, and new shares become hard to find, the cost to borrow skyrockets. While the exact number of shares currently available to borrow is unknown, that 773.1% CTB strongly suggests very tight supply. Over the last 30 days, TGHL stock price has actually increased by 35.1%, which means any shorts who initiated positions a month ago are now facing substantial losses on paper, adding to the pressure. Squeeze mechanics explained. So, what could this high cost to borrow lead to? A short squeeze. Here's how it works: short sellers borrow shares and sell them. If the stock price starts to rise instead of fall, these short sellers begin to lose money. If the price rises significantly, they might face margin calls, forcing them to buy back shares to cover their positions and limit their losses. This buying action further pushes the price up, which can then trigger more short sellers to cover, creating a rapid exponential increase in demand and price. It's a chain reaction where forced buying by shorts fuels the rally. The extremely high CTB for TGHL means the clock is ticking much faster for short sellers. Our internal composite squeeze score, which combines factors like CTB, borrow supply, and price momentum, currently places TGHL at 46.5 out of 100, a score that indicates potential, but certainly no guarantee. Dilution risk check. Before getting too excited about squeeze potential, it's crucial to check for dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. While this can raise capital for the company, it also dilutes the value of existing shares and can flood the market with new supply, making a short squeeze much harder to achieve, even with a high cost to borrow. For TGHL, we have some good news here. Our research found no recent dilutive SEC filings such as SMINUS-1, SMINUS-3, or 424B in the last 90 days. Furthermore, there have been no recent reverse splits for TGHL in our look-back window, which can also sometimes reset short interest dynamics. This clean slate on the dilution front removes a significant hurdle for any potential squeeze thesis. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given TGHL's current situation, what should you keep an eye on? Obviously, that 773.1% annualized cost to borrow is front and center. Today, TGHL saw a price increase of plus 6.57%. However, looking at the bigger picture, the stock is down minus 6.83% over the last 5 days, even as it's up over 35% in the last month. The volume data is also critical. Today's trading volume for TGHL was 522,400 shares. This is significantly lower than its 30-day average volume of 10,277,970 shares, giving us a relative volume of only 0.1x average. Highlight volume. This low volume today, despite a price bump, could suggest less immediate short covering activity, or simply lower overall liquidity. A true short squeeze often requires a dramatic increase in buying volume to force shorts out. While the high CTB indicates pressure, it doesn't guarantee a squeeze. Short sellers might have very strong conviction in their bearish thesis, willing to pay these exorbitant fees to stay short, believing the stock will eventually collapse. Monitoring volume spikes coupled with price increases will be key. So, there you have it. The Grow Hub Limited, TGHL, presents a compelling case study in the world of hard-to-borrow stocks, driven by an eye-popping 773.1% cost to borrow. While these fees create significant pressure on short sellers and set the stage for potential squeeze, remember that nothing is guaranteed in the market. Always approach these situations with thorough research and a clear understanding of the risks involved. We hope this deep dive into TGHL has been educational. If you found this information valuable, please hit that like button, subscribe for more content, and let us know in the comments what other hard-to-borrow stocks you'd like us to analyze next. Thanks for watching.